Today, I want to talk about how the shorts are doing everything they can to stop us, but how it's still not enough. Basically, I want to explain how major liquidations and forced liquidations are coming. So stay tuned and let's make some money. Also guys, later in the video, I want to talk about something really important, which is gold. We know the price of gold has skyrocketed over the last year or two, but there's tons of gold and silver mining companies whose stocks are still down massively. But first, let's dive straight in with the key information. So, we can see Dave Lauer tweeted saying that US equity markets have become fundamentally broken. Since November, more trading has taken place off of stock exchanges than on them, saying that price discovery is suffering and that this is a serious problem. Now obviously more trading happening off exchange rather than on exchange is nothing new for us AMC holders, but now this isn't just impacting AMC and GameStop isolated, it's now impacting the entire market. We can see this first chart is showing us on versus off exchange trading for 2024, where most of the year there was more shares traded on exchange than off exchange. But since November, this is now flipped. Especially in 2025, on a daily basis, we're seeing more shares traded off exchange than on exchange, something that's never happened before in history. He said when markets shift from on-exchange to off, price discovery suffers, markets become less useful for determining what companies are truly worth, spreads widen, liquidity drops and suffers, and companies and their ability to access secondary markets also suffers as well, all to enrich a few large firms trading off-exchange. Now this actually goes exactly against what a market maker stands for. A market maker is supposed to narrow spreads and improve liquidity, but this off-exchange trading is breaking all of that. The shorts and these market makers right now are in so much trouble, they're having to put more and more trades off exchange, not just for AMC and GameStop, but for the whole market, to try and save those few market making firms, effectively breaking the system and going against what they stand for. This Bloomberg article says that Wall Street has entered a darker age, with most stock trades being hidden. So it says, here's a surprising new fact about the world's largest and most liquid public equity market, saying most of the activity on it isn't public anymore. As we know, the US stock exchange is supposed to be the most liquid market in the world. But as Dave Lauer explained, with all of this off-exchange trading happening, there's less and less liquidity than ever. Now there's quite a lot of waffle in this article, but something that really stood out to me was this paragraph here where it says, theoretically, the more trading that goes off exchange, the fewer orders there are on exchange, competing to determine the best price. This means the pricing on and off exchange could get worse. Basically meaning the pricing on exchange isn't a true reflection of what the company is really worth, something we've been saying for years now. More and more of this trading is going from being on exchange to now off exchange and even OTC, where trades aren't reported at all. And the shorts are having to do this to try and maintain a slight edge against us. As I said, the shorts are trying to do everything they can to stop us, but it's still not working. Especially as Reese Politics tweeted saying, breaking news. Hedge funds have sent a wish list to the SEC on Tuesday asking for a 6-month delay on disclosure requirements relating to what short bets funds have against stocks. Saying some of these new reporting rules would have taken effect in February, in just a couple of weeks from now, but these shorts, these hedge funds, are begging for another 6-month delay. These shorts know that if they have to report more detail on their short bets, especially starting in February, it'd be game over for them. So they're desperate for another 6-month life extension. But something tells me, with Trump in charge knowing exactly what's happening to his company DJT and many others, he won't allow for this 6-month delay. But we'll have to see what happens over the next few weeks. Again, shorts are trying to do everything they can by trading off exchange and trying to delay additional shorting disclosures, but they're still not winning. On top of that, Travis has also given us the 4 types of FTDs that occur every single day, which I'm going to explain in a little more detail. Of course, the first kind of FTD that arises is plain old naked short selling stocks, when a short seller shorts a share without locating it, creating a failed to deliver and effectively creating a synthetic share. Tying in with that, we have the abuse of the option market maker exemption, which, being a market maker, allows market makers to sell shares without locating, but only for a temporary time period. But by abusing that market maker exemption, these market makers keep these short sales unlocated for a longer period of time, keeping that FTD in existence, keeping that synthetic short share or synthetic share in existence for a much longer period of time. Another kind of FTD we have is unsettled offshore trades, also known as failures to receive. When an offshore hedge fund or an offshore short seller or an offshore market maker sells or shorts a share, that sale doesn't have to be reported at all, creating an FTD that actually doesn't even get recognized as an FTD, like an FTD behind the scenes. Finally, we have unsettled long sales, where someone tries to buy a share of AMC, GameStop or any company out there, but the market maker can't locate a real share to sell to them, effectively again creating another FTD or another synthetic share to sell to that real buyer. So this is multiple ways FTDs and synthetic shares are created every single day, but it's still not enough for these short sellers to beat us. There's millions and billions of FTDs and synthetic shares out there, but the shorts still can't beat us and are desperate for another 6-month lifeline and are desperately trying to trade shares in the dark every single day. Now, I know all of you own AMC, but many of you also hold crypto, gold, silver, and other alternative against the system investments. We've just wrapped up Trump's first week in office, and it's abundantly clear that he's prioritizing domestic critical mineral mining development with new executive orders. Today's sponsor, Nevada Canyon Gold, ticker symbol NGLD, is doing business in the world's premier mining jurisdiction in Nevada and is executing what many believe is the most cost-effective strategy, royalties and streaming, and is deploying this in a first-to-market strategy. The reason why I want to talk about NGLD today is because the gold miners ETF, the GDXJ, fell by over 20% during Biden's reign, but last time it appreciated by 189% during Trump's previous presidency, and therefore in my opinion it could surge massively again. Nevada Canyon Gold seeks to lock the untapped potential of Nevada's legendary mining districts. With a unique business model and a strategic focus, Nevada Canyon Gold is redefining how royalties and gold mining are done. If you didn't already know, Nevada is the gold capital of the United States, accounting for 76% of the nation's production. Nevada Canyon's innovative approach avoids the high capital cost of mining operations. By focusing on royalty and streaming agreements, the company secures rights to production while maintaining a low overhead. This scalable business model ensures steady returns without the risks and costs associated with traditional mining ventures. Trump's deregulation in the mining sector will lower costs and expedite project approvals, making US gold miners more competitive, which is why I'm talking about Nevada Canyon Gold. Gold stocks, as represented by the GDXJ, are down 73% since 2011, while the spot price of gold is up nearly 40%. This, in my view, is a massive opportunity. History says the next move for precious metals could be huge, especially as gold has recently broken out of a 4-year consolidation. Robert List, the governor of Nevada from 1979 to 1983, joined the board of directors at Nevada Canyon Gold. List has been appointed to boards and commissions in the administrations of many previous presidents. Nevada Canyon Gold owns the Lowman property, consisting of 30 claims spanning over 600 acres in one of Nevada's historical highest grade mining districts. It also controls the Swales project, with 40 mining claims over 800 acres, as well as other projects like the Agaipa project and the Balthazar project, where Nevada Canyon Gold will make revenues for decades to come. Over the last few years, the NGLD stock has fell by 85% during Biden's reign, but since then the stock has bottomed out and is already up 130% since December, with tons of room to grow, giving us a clear uptrend and plenty of room for a squeeze. So research Nevada Canyon Gold, ticker symbol NGLD, on the OTC market today. I also wanted to again quickly touch on just how desperate Ken Griffin is, desperately raising $1 billion from external sources to pay off investors trying to leave his fund. G-America tweeted saying the face of a clown that is a market maker and runs his own security firm, supposedly making $94 billion with 19 other hedge funds in 2024, but needing to sell bonds just to raise $1 billion to stop AMC and GameStop from exploding. Supposedly, Citadel, DE Shaw, and the other world's top 20 hedge funds gained a record $94 billion in 2024. But yet, Ken Griffin can't even find $1 billion to pay off these investors. He couldn't even sell off less than 1% of his portfolio that wasn't tied up in margin loans or used as collateral. He had to raise $1 billion from external finance. Specifically, Citadel sold $500 million each of 5- and 7-year notes. That means Ken Griffin has to pay interest on this $1 billion loan or this $1 billion of finance raise for 5 to 7 years. He's going to pay not just $1 billion, but he's going to pay an extra 7% on that every year for another 5 to 7 years just to fund these old investors. As Bigham's added, he said, "I guess you forgot that Citadel needed a loan to pay back people not even 2 weeks ago." He said, "I guess you forgot they've taken a loan or sold off parts of their business over the last 3 years multiple times." He said, "I guess you forgot their credit rating is just above junk now." And he said, "Meanwhile, AMC in the box office and GameStop as well will both crush it and break US records." It seems crazy to me that Ken Griffin can't sell off just 1% or less than 1% of his portfolio to repay these investors, and that he'd happily pay somebody else interest for 5 to 7 years just to repay them. As I said, it's because all of his cash, 100% of his fund, is tied up on leveraged loans and being used as collateral. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.